All right, before we get into the equity-linked annuities, I went out the UTSA site again, and I wanted to compare what we talked about last time. Lance had a really good question, like, why wouldn't you do period certain? Why wouldn't you want to guarantee? And it's kind of shocking, Lance, that sometimes it doesn't make much difference. So yeah, you should do the 10-year period. So I did a 10-year certain and life only. Life only means the second you die, you lose it all. You don't get anything. Male 58. So if you do it 10-year certain, your payment drops $24 a month. So Lance, what would you do then? Get the 10-year period certain, right? 24 bucks. It's gonna, you get to cut out a couple of Starbucks a month, but it's not that big of an impact. It does make a much bigger impact as you get older. So I did an 80-year-old female, and there the difference, I don't know for someone should calculate the percentage difference, but $400, now it's starting to add up. $400 a month is quite a bit of money. You can buy your groceries with that or something, So as you get older, making sure, that this is guaranteed for 10 years, it's going to start costing you more. I should have tried this for like a 95-year-old. That would probably have a huge, huge difference, right? A chance of a 95-year-old making it 10 years would be pretty remote. So younger people, maybe it just depends. I mean, $20 is $20. If you have no heirs and you don't care, then take the extra 24 bucks. The other thing I want to show you is the difference between a man and a woman. So here I did 1939. What is that? 61. So it's 82-year-old. All right. So an 82-year-old. And which one is the man and which one's the woman? Can y'all figure it out? Man is on the left. How do you know that? Yeah, they're going to die faster, so they're getting more income. How material is that? That's pretty material. $500 a month, more than almost $600 a month extra just because you're a man. All right. So where does a woman get the advantage? When she buys life insurance, but when she buys an annuity. Now there are countries that gender-based pricing is illegal. France is real famous for it's illegal. That sounds really good, right? We do not allow gender-based pricing. What does that mean? You're going to overcharge women for life insurance. You're going to overcharge men for annuities. There's no winners. It's just, how do you want to charge people? Same thing on auto. Who loses on auto insurance when you don't have gender pricing? Who's going to pay more than they should? Women are going to pay too much. So someone did it on the chat there. Yeah. Well, men will win, but yeah, I mean, that's the thing with auto insurance. I don't know which question he was answering there. So yeah, so if you charge people the same, whether they're men or women are going to pay more for life insurance. They're going to have to pay, they get to pay less for annuities, and they're going to pay more for auto insurance than they should because men are worse drivers, die earlier, and I forget what the other one, well, die earlier is both the annuity. So we'll see how many phone calls I get from USA. I've already gotten 2 phone calls from the one I did last time. They haven't called me yet on this one. They may not on this one because they don't want to sell annuities, so they may not care. All right. So where are we going from here? So I want to talk about equity-linked annuities. And so let's just first, when you see the word equity-linked, what that means, wherever you see it, it means the return you get is tied to the stock market, but there's some guarantee of a minimum return. Okay, so it sounds too good to be true, and it is. We'll see in this article. You get the stock market upside, but you're protected from the downside. We're going to talk, where are y'all on options? Any of y'all trade options? Y'all know what a stock option is, a bond option, or a put option, call option. So I'll do a little review. We need it twice in this class. We need it when we do equity-linked annuities because we're going to use options to create them. So I'll give you some basic options on that. And then when we talk about annuities at the end, we're going to use the term that an annuity, a deferred annuity is really a short strangle. And so you have to know what a strangle is. So we'll talk about what a strangle is and what a short strangle is. And I'm going to try to convince you of that. I'm trying to help out the actuaries in an interview because to talk about annuities, that's a short strangle, sounds really impressive. I've had a few actuaries tell me, yeah, I brought that up in an interview, and boy, they were really impressed. So yeah, I'm going to make sure you have that, but I want you to understand it. So why are options so important for insurance? Well, insurance are options. So if you buy an option on Apple stock, a put option on Apple stocks, what does a put option tell you? What do you want Apple stock to do? Go up or go down if you buy a put option? You want it to go down. So you buy a put option on Apple with a strike of, boy, I haven't looked at Apple stock in a while. I'm kind of ashamed to say that because it's getting up there again, right? My word, these $2 trillion companies. So if Apple stock falls, the worst you can do is that strike price on that put. The put gives you the right to sell Apple stock at some price. So 150, let's say it's 150 bucks. So you have a strike of 130. So Apple stock falls on 90 bucks and you've got a put at 130. That gives you the right to sell Apple stock for 130. That's pretty good. You have a stock that's worth 90 bucks or 80 bucks, it falls, and you can sell it for 130. That's really good. All right. And you can actually even see their options here. So we're talking about a put option at 130. It would cost you about $6. So you pay $6. What happens if Apple stock falls to 140 bucks? What do you do then? You have the right to sell it for 130. It falls to 140. You're right. Their stock was going to fall. It fell to 140. How much money do you make? You just lost 100%, right? So Apple stocks, you're really good. Apple's going to fall. It falls a bunch, falls down to 140. Are you going to sell Apple stock for 130 if it's worth 140? No, that just expires worthless. What if it falls to 125? How would you do? Pretty good. You sell it for 130. It's worth 125. So you could buy from 125, immediately sell it with the option 130. How did you do with the actual option transaction though? How much did you pay for that option? $5.85. How much did you make on the trade at the end? $5. So you still lost 85 cents, but you did better. What if it falls to 100 bucks? Falls to 100 bucks, you can sell it for 130. You're making 30 bucks. You know, you buy for 100, you sell it for 130 with the option. You paid $5.85, then you got a huge return, all right? That's an option. What if you buy auto insurance on your car and you total it? Do you have the right to sell your car? Technically, no, but in reality, what are you going to do? You're going to sell your car back to the insurance company for its cash pay. It looks a lot like a put option, doesn't it? Auto insurance, you've got a car that has a cash value of $15,000, it's worth $20,000, you wreck it. The insurance company gives you $15,000. Essentially, you sold your car back to them for $15,000. So you've got a life, your human value is $1 million. You die, what is your family going to do? They're going to sell your body back to the life insurance company, whatever the face of that insurance policy is. It looks just like an option. All right, so insurance is an option. I don't think actuaries use option pricing models in their pricing, but it's very similar to an option. So, and what do we call your insurance revenue? You know, what you pay the insurance company, we call it a premium, just like we call options premiums. So we're going to get into this more. We're going to have to understand how options work. But the put option is what's going to help us get that floor on our return. So we can lock that in, make sure we never lose more than this, and then we get as much of the upside as we can. And it's a great strategy. I like it a lot. So we'll get into that. So let's walk through this article so you can understand why I love the strategy. I love this strategy of get the upside, but cut off the tail on the downside. But I don't like equity-linked annuities, okay? So this is an old article. Sorry about that. I wish that someone would update some of these articles. It is an EIA working paper. I forget what else SLCG is, but these are a couple of legal types going through this. Equity-linked annuities were really the center of their market. Just everybody was buying these things. They were really, really, really popular. Were they buying them because the customer wanted it, or were they buying them because the sales force liked the massive commissions they were getting? That you'll have to kind of figure that out. It's regulated by the state insurance, but it is not regulated by the SEC. That is still true today. These are still not regulated by the SEC. So they don't like this product, so they're kind of in my camp. They say 15 to 20% of what you pay for an equity-linked annuity is a transfer of wealth from the consumer to the insurance industry. That's what they're arguing. And here we're not, here these can be significant premiums. So I think I talked about the guy who put like hundreds of thousands of dollars into this all at once, one massive single premium. And if there's a 10% commission, boy, those sales reps, they were really happy to do that. And we talked about this. The SEC, one of the things I look at is there any insurance? And so insurance companies can add some insurance to try to make it look more like an insurance product. They're not going to sell it like that. They're not going to advertise the insurance piece, but they put enough insurance bells and whistles into it. The SEC says, okay, well, maybe that is insurance. They're disadvantaged tax-wise. We'll have to kind of see why that's the case. High costs, we've talked about that as well, right? Insurance companies are more expensive than banks and mutual fund companies. Insurance companies have disadvantaged tax, there they were talking about variable annuities. They're essentially saying what we said about variable annuities applies to equity-linked annuities. The only difference is variable annuities are regulated by the SEC. Equity-linked annuities are not. Sorry, I forgot they're comparing those two. All right, so investors in equity-linked annuities cannot determine what they're buying. So this is my complexity product, ultimate complexity product. Now, why can't you just compare two equity-linked annuities? So you're going to see why that's the case, and it has to do with the way the actual index is calculated. They say virtually impossible. Maybe we should go find someone who sells this product and have them come in and see if they can explain it. They're not saying this is virtually impossible for the consumer to understand. Whom are they talking about here? They're talking about people selling these, that these are virtually impossible for them to evaluate and compare one product to the other. So high commissions, usually higher than even for variable annuities. Potentially misleading marketing claims, some of them definitely are. Any recommendation to liquidate securities to purchase an equity-linked annuity requires a determination that they are suitable. Right, so y'all know the difference between suitable and fiduciary. Have you ever heard that debate in your business law class? Which would you rather have as a consumer? Would you want suitability standard or fiduciary standard? I want a fiduciary. What does fiduciary say? I got to put your interest first as the buyer. All right, so that's really good. What does suitability mean? I probably exaggerate, but I describe it as you can imagine there's someone on the planet that would buy a product like this from somebody. My product might be horrible, but if someone would buy a product from another company that's decent, then my product is suitable. You can imagine. Now, remember I talked about Donya and they sold her variable life. I don't know how you can make a suitability for her. She had no dependents. She needed to live off of her, so why would she ever buy? So I would have loved to have taken that to court. I kept wanting her to, let's sue this company, let's go. And she's like, no, I just want my money. But I think I could have made an argument that wasn't even suitable. Usually you can drive a truck through the suitability standards because they're a really big standard. Now, President Obama actually was imposing fiduciary standards on some of these industries. And people saw that was really, really good. But I heard what some companies were doing. It was making it even worse. So there's a big debate of how do you clean up this industry, and just telling them you have to be fiduciaries, even that doesn't seem to fix it all that well. But that's the big debate. Do you want them to have the suitability or fiduciary standard, and will that actually clean up the industry? So NASD is trying to clean this up. Some people are saying they're too complicated, and I agree with that. And the complication hides all these costs, which I don't really like. And I'm going to try to prove to you the complication. So the industry fights back. They have no trouble fighting back. If you take some behavioral finance classes, we're going to talk. You talk about this in Article 3, right? Some of these biases. We're very loss averse. So what does that mean? You go out to somebody and you have two groups. One group is going to benefit. One group is going to lose. Which group is going to fight harder? The winners or the losers? And the way we're structured, the losers fight like 1,000 times harder than the winners. The winners are like, yeah, that sounds nice. Yeah, whatever. The losers like, they're going to go storm Washington and they're going to fight hard for it. And that's essentially what it is. These people with these great commissions, they love this. It's very lucrative to them. They're going to fight hard. The consumers that would benefit from fixing this industry, they're probably not even aware this is even going on. Equity-linked annuities are not suitable for seniors. Not all of them are bad, but a lot of them are very bad, but I think they're all far too complex. Okay, so you get this guaranteed minimum rate of return. They don't guarantee that you won't lose money. They do guarantee a minimum rate of return. So what does that mean? So the stock market's up 20% the first year, so your equity-linked annuity is up 7% or 10%. That's good. So you made 10%. The next year, the stock market crashes 30%. Are they going to guarantee the 3% the next year? No, they're going to guarantee a cumulative 3%. So what did you do the second year? You lost money, right? Whatever you made in the first year, you lose that. So you can have negative returns. You just can't accumulate a negative return. All right. So if you're up 30% and then you're back down to 3%, that's pretty painful, isn't it? You feel like you lost money. So that guaranteed is over time cumulative, not year to year. The guaranteed rate is typically much less than the risk-free rate. Why is that? You're going to see that when we actually price these things. It's mathematically impossible to give someone the stock market and guaranteed a 4% return, and you're going to see why. There's no mathematical way of doing it. And right now, these things are really difficult to do because we're at treasury rates right now, 1.3%, 1.4%. You don't have much room to work with even then. On some of these, the guarantee goes away if you surrender it early. Well, that's pretty painful. It's not painful after 1 year maybe, but after 10 years, that could be horrible. And the guarantee may not actually be applied to your entire contribution. You can see how this complexity is building up and building up and building up. So you tell someone, hey, I'll guarantee you a 3% return. What's the first thing most consumers are thinking about? Stock market's up 20%, I'll make 20%. Stock market falls 20%, I'll make 3%. So after 2 years, I got 23%. And then you tell them, well, no, after 2 years, you'll have what? 3% compounded. You will not have 23%. But that's what most people are thinking. How do you think the salespeople sell it? Wouldn't that be interesting to sit in on some of these calls? Say, hey, you're guaranteed 3%. They probably don't say cumulative. So the next thing they do is a lot of these are based off of the index. The indexes are price-only indexes, which means they exclude dividends. How important are dividends over time? Incredibly important over time. That's a big part of the return. Exclusion of dividends causes the change in the S&P level to significantly understate, as dividends have historically accounted for 20% of returns at S&P 500. All right, the participation rate. So here we go. This is where you get really complicated. Participation rate is the fraction of the market that you're going to get. So let me ask you, which would you rather have? 100% participation or 50% participation, just on the surface, without any more information? So company A says, hey, we give you 100% participation in the stock market with a 3% guarantee minimum. The other company says, well, we give you 50%. You know it's a trick question, but what would be the obvious answer? 100%, right? I want 100% participation. Is it possible you have a product that's 50% participation and you actually get more of the upside than 100% participation? Absolutely possible. All right. They're easy to compare, 100% versus 50, but a higher participation rate does not mean you're going to get more of the upside of the market. Now, why in the world would they design it? Why wouldn't they all have the same process? Obviously, because it makes it much easier to sell a bad product. So there's the point-to-point method. There's the monthly average return method. So let's try it. So let's do point-to-point. And you have 50% participation, all right? And let's say the S&P starts off time 0. Is that large enough? Can y'all see that? Sorry about the screen, boy. All right, so let's say the S&P starts up at 3,000. And it just goes up like that. So point to point, and the monthly average is 100%. Okay, so let's try. Point to point, the S&P is up how much? It's up 10%. So how much do you get credited? You make 5.23%. That's pretty good. How does the monthly average work? Equal average. That divided by your beginning minus 1. That gives you 5.16. You get 100% of that. So which did better? What percentage of US retail consumers are going to understand that distinction? Now, it can get much worse because I did it straight line. There's all different kind of combinations that you could get. You could certainly have the market not move at all and then go up 10% right at the end. What happens then to your monthly average? That's the worst case scenario. Now, which one would you rather have? Or it could go up 10% the first month. Now, which would you rather have? So it depends. Y'all see that distinction. So when you do that monthly average, it depends on the path the market took. But what do you think the salesperson is going to do working for company B? Do you think they're going to push that 100% participation? Probably so. So it's incredibly complicated. I don't know why regs don't just say, hey, y'all going to pick a method and stick with it. We can't have all these different methods that give these radically different answers. So it's pretty ridiculous. Now this article, you can see how long it was written because it's talking about an S&P at 1700. So insurance companies can offer higher participation rates on annuities with monthly averaging versus point to point because monthly tends to systematically reduce. On average, I gave you two scenarios there where you got radically different answers, but on average, it's going to understate the actual return. So they give a figure here, figure 1. Here's the S&P 500 return. You start with $100, you would have ended up with 4,921. That's really good. Do without dividends. Now I said it's 20% of return, but y'all know how compounding works, right? If 20% of the compound return is dividends, what happens to that amount over time as you compound it? It's not a 20% difference, is it? It's a huge, huge difference. If someone thinks they're getting this and they're actually going to get that, that makes a big difference. And then here's the monthly average. If someone thinks they're going to get that and they're actually getting that, is there a flaw in the product? Maybe so. Right? We'll give you 100% participation. Wow, that's great because look how markets so. And then if this happens, at least I'll be making 3% here. Well, no, you won't. You're going to lose all of that, and we'll bring you back to 3%. So you'll essentially be way down, you know. So it's not a good product.
So just to clarify, are you buying some version of the stock that they're offering? Is that like they buy the stock and they give you like?
Well, they're buying the S&P 500, and they're hedging it with indexes. Okay. I mean, with options.
I don't know what the first product means. They're buying the S&P 500.
Well, they're buying an index fund, like an S&P 500 index fund. Okay. So they're buying something because they can't take the stock market risk, right? These are very thinly capitalized firms. Most of them have $1,000 in assets and $100 in net worth. So they only have $1 for every $10 of assets. So life insurance companies cannot invest in the stock market. So if they're going to give the stock market to their customers, they're going to have to buy the stock market. They might not buy the stock market. They may buy options on the stock market. They're going to maybe replicate this in some way. But they have to have something that's going to give the customer exactly this 544. So they're going to have to set that up to do that. They can't necessarily have something that's going to go up to this 49.21 because what's the problem with that? If they buy something that does this and then does that, what's the problem for the insurance company? Well, they're paying this. What happened in this year? They're in a lot of trouble there, right? So they have to find something that replicates this quite precisely, and that's what they're going to be setting up. But if they're advertising this, my main point, if they're advertising this to the customer and this is what the customer is going to get, customer may be a little disappointed. The life insurance actuaries have to make sure they can replicate this black line. And I'm going to show you how a retail investor would do it, how life insurance companies actually do it. There's several different ways they could actually structure that to work. But this is pretty startling, right? Now, he picked a time when the stock market was doing extremely well, you know, with the up into the 2000s. So, you know, this is a pretty start going from the 70s, which is a really bad stock market. And you can see the 87 crash in there. It doesn't look all that impressive. He didn't use a log normal graph. This would have been a little more interesting. It wouldn't be quite so stark if it was log normal, right? Because then, you know, you wouldn't get this massive, massive jump. But the numbers at the end are pretty telling. So you tell someone 100%, and they're actually only getting a small fraction of that. So here they did it for 10 years, and it's still a pretty stark difference between the two. Here, I think they just said what I did was just a constant return the whole time, just to show you the difference in those three without all the volatility. It makes a huge difference. Well, that's not where it stops. So that would all be nice if that was, well, that would be horrible. That would all be horrible if that was all there is, but there's a lot more going on. The gross credit calculated by multiplying the index by the participation rate is then sometimes further reduced by a spread. So they have expenses, so they have to subtract their expenses off. So that comes off. Thus, the two contracts linked to the same index, it all depends on what their cut is. Different companies have different cuts. And then it gets even worse. Some companies actually put a cap. So, hey, if the S&P is up 20%, the most you can get is, say, 14%. Well, what's the problem with that? Well, the stock market tends to do that, have these 30% years and then these negative 10%, and then you can cut a lot off the index here. So the annualized price appreciation, the S&P 500 was 10%, but if we capped it at 14%, depreciation drops drops down to 5.5%. That's how material it is, cutting off those tails in the S&P, because you need those 30% years. Y'all probably have seen those studies where if you invested your money the last 30 years, but you missed the 10 biggest days, how massive that is to your return. And that's kind of what we're seeing here. You miss those big years. So these things are so that you can get the market participation without worrying about the downside. So what they said is, well, let's just compare this to a real simple strategy. And let's buy treasuries. They're getting really simple. Let's buy treasuries. They're not even buying corporate bonds. So they're cutting their return with treasuries. Let's just buy the S&P 500 in treasuries and look at that over time. And this is what I think, if you're buying an equity-linked annuity, you should have the right to ask the salesperson to say, hey, show me how this would have done with just a simple 60% S&P 500, 40% treasuries. Show me over time, over all different 10-year time periods. So 60,000 invested in treasuries. Oh, they did 60 treasuries, 40 S&P 500. So index fund, y'all know index funds, or y'all know what an ETF is, exchange traded funds. So you can essentially buy the stock market, low fees, whatever the S&P 500 does. Like today, you would have been up a bunch. It's been kind of nice. And a couple of days ago, you would have lost a bunch. So here's what they showed. So there's treasuries, there's the equity-linked annuity. 96.9% of the time, you would have been better off the treasuries and the stock. But it gets worse, right? So most of the time you're better off. Now you might say, well, then, but 3.1% of the time, this thing's going to save my hide. That's not the answer to that. 3.1% of the time when it wins, it doesn't win by much. There's a lot of this 96.9 where the treasuries and the S&P do a whole lot better than equity annuity. But when the equity-linked annuity does better, it doesn't do better by much. So after 10 years, the treasuries, they had an expected value of not 220,000. Equity-linked annuity was 186,000. 219 is, so when the annuity does better, it was 219 expected benefit. When the others did better, it's $36,000. And then they say even this is overly generous to the annuity because it assumes they're held to maturity. And I would, this is my real cynicism in the market. I would say some of these are not held to maturity because what happens when the sales agent from company B discovers that you have an equity annuity for company A? What are they going to do? Y'all know that word? You ever heard the word churn? What is churn? Anybody know the word churn? What does it mean for an insurance salesperson to churn? They get you to sell that company's product and buy your product. Can you imagine what would happen to this product if you did that? You're just like, you have no hope. They talk about the tax advantages. The returns earned on equity annuities are taxed as ordinary income versus capital gains. So that can be pretty material. I don't know what those differences are right now. They've been getting closer together, so I'd have to go look those up. They're probably going to get wider here under Biden, but so they give you some numbers if you actually want to go through all that. Equity index annuities do not have explicit annual fees. Instead, the insurance company makes money by giving the investors less. The insurance company, they get the dividends, their spreads that they're taking out. So they don't actually charge fees. Equity annuities are complicated investments, so the unsophisticated investors without the regulatory safeguards of the SEC. Now the NEIC, the state regulators do regulate this. And I'm sure if we went to NAIC's website for all the regulators, this is probably a hot topic that they talk about, and there probably have been some rules put in place. They say no registered rep, insurance broker, or retail investor or process fees, PhDs, finance PhDs could understand these products. The net result of annuities, their complex formulas, hidden costs is that they survive as, they say, the most confiscatory investments sold. I think it does get worse because now they're doing the equity-linked universal life. So annuities are pretty straightforward. Universal life, you already saw how complicated that is. Now you add in an equity-linked annuity on top of that. You're like, now who does understand these? There is one person who understands these products. Who has to understand these products? Any ideas? There's got to be one person who has to understand these products. Who? I don't think the agent does. They should, but I think there's a lot of agents that, I mean, they understand it at a high level, but getting in the nitty gritty, I would imagine there's several of them. And the way I would test it is show me this product over the last 20 years compared to the treasuries and S&P. I don't think there are any agents that could actually do that. Sit down and take their product and actually figure out what it would do over that time. But I agree that they should, but I don't think they could. If someone wants to bring an agent in, they can. Any other guesses? Who has to know this product? Huh? The payout, that's probably the computer. So who put the formula in the computer? And it's going to be you, right? Who are you? Who are you going to be in 5 years? Actuaries. Why do actuaries have to understand this product? Because if they do it wrong, what happens to the insurance company? They go under. So actuaries have to understand it. That's the one person in the company, they better know it, because boy, one mistake and the whole company goes under. So yeah, the actuaries better understand it. And then they got to make sure that the investment team knows what to do, because the investment teams aren't going to understand this product. So the actuaries got to tell them, buy this, do this, because you have to replicate this. You might say, well, that looks really easy to replicate. I can find it again. This looks really easy to replicate, but this is probably still a higher return than what the bond market's providing by itself. They can't just go out and buy bonds and hope for the best. They've got to have something that is going to closely insurance. We're going to talk about this asset liability matching that insurance companies do. Their assets have to perfectly match their liabilities, and they have very little room for error. And this would be a disaster right here. If they had this and they're guaranteeing that, that would be a disaster, to be sure. All right. Now, anybody want to defend equity-linked annuities? I'm all ears. Do any of your parents own one of these things? That's your next conversation at Thanksgiving. But like I told you, the guy who bought this had no idea he bought this. He was buying equity-linked universal life. He thought he was buying an annuity. He thought he was buying an investments. So think about how horrible that is. He thinks he's buying an investment to build wealth over time, and he's paying insurance premiums on his life. That's expensive on a 70-year-old person. His life insurance premiums are massive, right? He's paying a lot for insurance. So if he dies, his spouse is going to get all this money, but he doesn't know he's buying life insurance. How can someone buy life insurance and not know they're buying life insurance? So don't you wish we had a video of that sales pitch? Wouldn't that be great for this class? I should have asked them to do that. That's what y'all can do. One of y'all act like you're interested in an equity-linked universal life and have the salespeople come in and film them. I don't know if you can film someone in your own house without them knowing about it, and bring it to the class. It'd be really interesting to do. All right, we don't have any defenders for this product. All right. That's right, I don't see anything on the chat either. All right, so, but I like the product. I mean, I like the concept. So let's look at the concept. What time is it? 9:40. We'll do this quickly tonight. We'll walk through it, talk some of the math behind it, and then we'll do a more extensive problem. This will be on the exam. There's a 99.9% chance this is on exam 1. And what is the 0.1%? That's my mortality. So if I die, I don't know what will be on your exam, but so there's a high probability this will be on the exam. So let's set it up. So making sure you understand options here. Boy, this is an old problem when the S&P was so low. All right, so let's go back to our, why did they change colors right here? Anybody have any idea? It went from what to what? It went from, these are the, let's do the puts. So we go from white to blue. The white is what? Anybody know what that's called? In the money. So puts are in the money when your strike price, no, it's backwards. What is this? Calls. The calls are in the money, right? So the put is in the money when? Up here, right? What does in the money mean? In the money means you would execute that put. So would you sell Apple for $170 if it's currently trading for $150? Yes, I would. So that's in the money, that's good. So what is this? What is 130 then? Out of the money, all right? So options can be in the money or out of the money. These are put options. Call options, the exact opposite. Would you buy Apple for 120 if it's currently trading for 150? You have the right to buy Apple for 120 and it's currently trading for 120. Would you do that? Yes, so that is in the money. Boy, I had it right the first time. Would you buy Apple for 190 if it's currently trading for 150? No. So call options you buy, put options you sell. Would you sell Apple for 130 if it's currently trading for 150? No. Would you sell Apple for 170 if it's currently trading for 150? Yes. Sorry about that. All right. So the blue is in the money, the white is out of the money. Boy. All right. So what we're going to do is we're going to buy a put option that is at the money. So what is at the money? That would be an option right at 150 for Apple. Okay. So I don't tell you what the strike is on this option. You just know what the strike is because I tell you where the S&P is. So if it's at the money, then the strike is right at that. So let's give some terms here. So you got the option premium. That's how much the option costs. We're going to ignore the option contract of 100. So ignore. Some of y'all know when you buy options, you have to buy them in 100 instead of 100. Just ignore that. We're only doing, it's just one option, all right? So don't multiply by 100 for this class. At the money means that the strike price equals current level market are the securities. So like for Apple, if Apple's trading for $150, a strike price of $150 would be at the money. Okay. What does strike price mean? It's the call, it's the price we can buy at. It's a put, it's the price and sell at. All right. So for a call, your strike price is what you get to buy Apple for. So if your strike price is 120 and you're trading at 150, that's good. You buy for 120, you turn around and sell it at 150, you made 30 bucks. For the put, if the put price is 170 and they're currently trading for 150, you sell it for 170, you buy it right back at 150, you make 20 bucks. All right. So there's the strike price. We're going to buy a zero coupon bond. It's just a bond you buy at a discount, pays no interest, matures at essentially $1,000. Why am I doing a zero coupon? I'm just going to simplify things because if we have a bond that pays interest, then we got to worry about what we're reinvesting that interest at, and that really messes things up. So we're gonna ignore that. All right. So any questions on this? If you haven't had any options at all, you don't really need it for this problem because you just do the same calculation over and over again. So you'll see once you learn it, you have it. But it's good to have a good background on options. Just as a finance major or an actuary major, I'm sure options are on the actuarial exam. I've seen part one of the actuarial exam. It's the only part of the actuarial exam I can actually pass is the investment part of that exam. It's a tough exam. All right, so let's do the math. I think it'll be more straightforward once we see it. All right, this life insurance company is selling a single premium deferred equity annuity. So a single premium makes it really easy because we just get one premium today, 200,000 bucks. Someone walks in, hands us 200,000 bucks. Your commission's 10%. You're really happy. You just made 20,000 bucks. It's going to guarantee you a 1.5% return. And it's going to mature in 8 years. So you know for sure the worst case is you're going to make 1.5% compounded interest for 8 years. That's the worst you can possibly do. The S&P 500 is at 1450 today, or whenever I did this. The option costs you $500. And again, don't multiply by 100, all right? If you don't know what I mean by that, just ignore it. The premium's $500, so you don't have to worry about that. And you can go out and buy a bond that's paying 4.5%, but it's a zero coupon bond, okay? And so these are the questions you get. I kind of walk you through the problem just by doing the questions. So let's see if this makes more sense just by walking through the problem. Now, some of y'all took my class last year or last semester, the property and casualty. Anya, you remember that the risk securitization problem? Does that come back to you? And so it's going to look real similar to that. We have this guaranteed, and it's going to be similar. All right. So the first question is, how much of this bond are we going to buy? Well, the nice thing is, we only have to guarantee them 1.5%. And we're going to assume this thing's going to mature. So we're not worried about default risk on this. Now, the article, they use treasuries, so you even have less. But most life insurance companies don't buy treasuries. They buy corporates. So they do take the credit risk. So we're going to assume this thing is going to pay off. So we're ignoring credit risk. So we only have to pay this person 1.5% guaranteed, and we can make 4.5%. So let's start off with the first thing we do is let's calculate the guarantee. What do we have to have at a minimum in 8 years? So they give us 200,000 bucks. They need to make 1.5% for 8 years. Does that formula look okay to everybody? Anybody not familiar with that formula? That's the future value formula. You remember that from 3013 probably? Do all of y'all have to take the FAC exam, or is that just the finance majors? The actuaries, you have to take FAC exams?
Financial math is a future comes.
But you've had future value. You had to take 3013 as well. So, well, Lindy was in my class, so you remember these calculations. So that's just a future value problem. So how much money better we have, do we have to have at a minimum? So $200,000, $1, 2, 3, times 1.015 raised to the 8th. I'll hit enter as soon as someone says what they got. Can y'all do it in your head? Probably not. So, anybody have the answer? Practice it now. You're not going to do better on the exam by staring at me, because I don't think staring at me has helped anyone do anything. So practice the math on your own. You on the Zoom can do it as well. All right, that looks good. Is that what you said? All right, so 225, 299. We can round if we want to. So 225, 299. If you want to go out to the pennies, that's fine. But 225, yeah, I have to remind me. Does that look right? 225, 299. All right. Now, how are we going to get that amount? Well, we're going to say, see how much to invest at 4.5% to obtain 225, 299. And how do we figure that out? You take 225, 299, and do what? Any takers on that? How much do we need to invest today at 4.5%? So that in 8 years, we'll have 225, 299. That sounds like a present value problem, doesn't it? How do you do present value? Yeah, exactly. Divide by 1. 1 plus 0.045 raised to the 8th. See what you get when you do that. One 150, how much?
158, 426.
Okay, 158, 426. All right. Now think about this strategy. This is a strategy that I really like for especially retired people. So someone comes in and says, you know, I need my portfolio to make me at least 1.5%. I got to stay up at least with inflation. All right, can you get me that? Yeah, I can go out and buy this bond. Now, I probably wouldn't put it all in one corporate, and they're not going to put it in one corporate bond. They're going to put it in, you know, 50 or 100 corporate bonds. It's going to be diversified. So maybe you put this into a low risk bond fund, and it's yielding 4%. So you say, okay, if we put enough money in, if we put $158,000 of your money into this bond making 4.5%, you will for sure over the next 8 years make at least 1.5%. So they gave us $200,000. We've only invested $158,426. So we got some money left over. How much money do we have left over? Now, some students take 225 minus 158, and that would be wrong. We're talking about how much money we have today. So what are you going to do here? It's 200,000 minus 158, 426. I should be able to do that in my head. Not with actuaries watching me, but is that close? All right, so 41,000. So let's think about it. This is a wonderful thing. You invest 158,000 and you're going to guarantee yourself a 1.5% return. And you got 41,000 left over. What do you do with it? Whatever you want to. You can go to Vegas and gamble it. You could put it all in one stock. You could put it all in then call options on one stock. And whatever you decide to do, what's the worst thing that can possibly happen to you? You make 1.5%. This is a great strategy. I like this strategy. There's all kinds of things you can do with that money. What are we going to do with it? Well, I didn't give you many options. Well, no pun intended. That was by accident. So I didn't give you many choices. What's the only thing you can do with that money? You can buy an option on the S&P 500. Here we're going to actually buy call options. All right, so how many can we buy? So number of options, it's going to be the 41,574 divided by the 500. Each option costs $500. So how many can I buy? 83. Okay. Real quick, just check. I'm sorry. Wait. Boy, I don't know what I just did. Yeah, 83 or 84. So rounding is not an issue. Oh, wait. What did I do? What did I do wrong? Ah, I just made a mistake I told you not to make. Boy, this is not my night, is it? You can tell it's getting late. So 83 is fine. If you round up to 84, that's fine. On this problem, I really don't care about decimal places. I'm going to show you how it can cause a problem, and you'll see, but I don't think rounding will cause the problem I'm going to tell you about. So 83. You don't have to buy these 83 options. We could have done 83 options on the Japanese stock market, on Apple stock. We could do it on kinds of things. And why are we doing the S&P 500? Because that's what the contract's based on. So obviously the insurance company wants it to be directly tied to whatever they're guaranteeing. All right, so what you need to do then is fill in this table. So what I ask you is, what is going to be your ending portfolio, the equity-linked annuity, if the S&P 500 falls to 870, if it goes nowhere, it just makes a 0% return, or if it almost doubles to 2850, okay? So the first question is, how much is your bond portfolio going to be worth? So that you can do without doing any calculations. So what is that bond? You bought a bond for 158,426. You invested it at 4.5%. What is that bond going to be worth at the end of 8 years? Someone yell it out. You don't need to calculate it, and you can. 225, 299, right? You know for sure that's going to be the case. What if the stock market doesn't do anything? What will it be? 225, 299, 225, 299. So no matter what, we're going to make that 1.5%. What about the call option? All right, so here's the formula for the call option. Those that took my investment class, do you remember this formula? Takers, some of y'all took my investment class. What's the gain on a call? Start with the word, sounds like a guy's name. Max, we're gonna max something. What are we gonna max?
Not the value of the stock at the time minus the strike.
All right, so the underlying, which we'll say the stock minus the strike. If the stock's trading for 800 and the strike is 1400, we're going to do the max of that and what? Do you have to execute the option? Why is it called an option? You don't have to do anything at the end. You can select. So if the stock's worth 800 and you have the right to buy it for 1,000, what are you going to do? Just let it expire as worthless. All right. So there's your gain there. We don't have to subtract the premium in this particular case because we've already taken that out in the number of options we bought. What about a put option? It's the max of what? Strike minus the stock. 0. So there, it's a little, we'll see that when we get to the strangle later. So here we have a call option. We could have done this entire strategy with using puts, so that you can get it both ways. Something I recommend, if you're not familiar with it, go and look up put call parity. It's a really cool term. So obviously you'll see that in the investment class because we're going to talk about put call parity in that class. I love put call parity, but you can essentially replicate this with calls. You can do it with puts. So there's many different ways you can do this. You can do this with swaps. There's a lot of different ways, or swaptions. So we're going to do it with calls. And so in this case, what we're going to do on the options, it's going to be the max of the S&P 500 minus our strike. 0. So in the first case, we have the max of 870. And what was our strike? Well, it was at the money. So the strike's going to be wherever the S&P was when we started this. So 1450 and 0. And we have to multiply. One thing I left out is you got to multiply it by the number of options you have. So how many options do we have? 83. So 83 times 0, what do you get there? You get 0. So the option portfolio, if the S&P 500 crashes, what are they going to get? They're going to get their 1.5% return, and they should be happy with it. What if the S&P doesn't move at all? So we take the max of 1450 minus 1450 and 0. There is no max there. It's just 0. So there, they've made 0. Then we do the very last one. S&P's up to 2850. So here we're going to have to do the math. Sorry? You got it?
Well, not nice.
Well, you have to multiply by the 83, but yeah. So the max, 2850 minus 1450 and 0 times 83. Anybody got it? 116,200. You probably still have the decimals out there, which is fine. 116,200. So what is an equal-linked annuity? It is that guaranteed bond portfolio that you set up plus the value of the options. So you just add across 225, 299, 225, 299. And oh, I should be able to do that in my head. 2, 3, 41, 499, but I don't guarantee that. Does that look right? Someone check the math for me. We have actuaries in the room. Y'all got it? Is that close? I don't like doing math when people are looking at me, but okay, hopefully that's right. All right, so what is your return? So how do you calculate your return here? So your return is going to equal your ending value divided by the beginning value raised to the 1 divided by n minus 1. Good old Kaggle formula. So the first one should be pretty simple. 225, 299. That's my ending value. What was my beginning value? How much did this person invest initially? Notice how much we invested in the bond. How much did the person who bought the annuity invest? Exactly 200,000. We take that, raise it to the 1 over 8 minus 1, and I'm sure hoping I get what? 1.5%, right? I sure hope. Now with rounding, it might be 1.500013, whatever. I'm sure hoping I get 1.5. Let's just try it, make sure. It's a good double check on all of Lindy's work there. 225, 299 divided by 200,000. 1 divided by 8 minus 1. Pretty close. 1.5%. Questions on that one? That's the key. How does the investor feel? Well, they're a lot happier with this than they would have been if they'd just been in the stock market. But what did that article compare to? It didn't compare to 100% in the stock market. It put 60% in bonds and 40% in stocks. There's a good chance that 60-40 would have done about as well as this. This is probably one of the scenarios where the equity link did better. But remember, if you go in the stock market, you're also getting the dividends, so that's going to help you some. And you're getting the treasuries. At the time they wrote that article, treasuries were probably yielding 5%. So it's really tough today to get this strategy. This is a tough time to do this strategy because interest rates are so low. All right, what about the second one? Well, the second one's exactly the same thing. So we make 1.5%, make 1.5%. So now we just have to do the very, very last one, 341, 199 divided by 200. 1 divided by 8 is 1. And I've already forgotten the numbers. 499 divided by 200. Anybody got it? Anybody besides Lindy? Lindy's our calculator over there. Anyone else have it? You got it, Ricardo? Green, you got it? You're definitely going to want to bring your calculator when we get into the pricing because we're going to be doing a whole lot of math. It looks pretty good, doesn't it? You're up $141,000 on a $200,000 investment. That sounds like a really good return, but when you do it over 8 years, it may not be all that impressive.
6.9%.
All right, 6.9. Let's go out a couple decimal places there. 6.92. So right, the same thing on the S&P 500 for the formula. So we want to compare this to how we would have done if we just stuck all the money in the S&P 500. Again, that's not the right comparison. This really is more like a bond and stock. But I want to make a point with this because it's going to look like something. I keep talking about put options, and I want you to see what this looks like when you do this. So the S&P 500, you have 870 over 1450 raised to the 1/8 minus 1. We already know what this one is. That's just 0%, right? You started at 1450, you ended up at 1450, you just made 0 that whole time. So that one's pretty simple. And then the last one is we have 2850 divided by 1450 raised to 1/8 minus 1. $70 and 2850. I can't remember tonight. Sorry. All right, Bill Gates is not helping me out here. All right, so these numbers are actually quite important for what we're going to be looking at here. So I'll just do them real quickly. It's a loss of 6.2%. And a gain. Oh, sorry. And a gain of 8.81%. So minus 6.19%. Oh, thanks, Bill Gates. He thought I wanted to change fonts. All right, so one thing I've added that's not in this question that is going to be on the question on your exam is I want you to actually graph this out. And there's a real good reason why I want you to graph this out. So let's see if I can get this whole table. Ah, Bill Gates. Should have known I didn't want to do that. I want to copy. There it is. We'll see. All right, so let's put those in there. So if the S&P is at 870, at 1450, or 2850, our annuity makes 1.5%, 1.5%, or 6.92%. The S&P makes minus 0.0619, 0.0881. All right. So I want to draw a graph and see if any of y'all recognize this graph here. All right, so I should have done it as XY, so there shouldn't really be a kink in here. But so here's the market. If the market falls, you lose money. If the market goes up, you make money. What does this blue line look like? Anybody remember that from your investment class? What is that? It looks like a hockey stick. What does it look like? Looks like a call option, R. What's the other thing it could be? Obviously taking that class now, so you'll see it a little bit. So what are the two things? Put call parity. What are the two things this looks like? Anybody remember? Well, let's look up put call parity, and you'll see there's Investopedia about like Wikipedia. So what does put call parity tell you? Anybody want to guess what C means? Call option. What does P stand for? Put option. What's the S? That's the stock market. Anybody want to guess what D times K is? All right, so C is the call option. D times K is the strike price, but in present value terms. Okay, it's like buying a bond that matures at the strike price. K, now it depends on whether you bowl or you play baseball. All right, so K is what in baseball? A strike, right? I use X's for my strikes because I don't bowl or play baseball, but I remember strikes in bowling. So the D means you're taking the present value of the strike price. And so what they're saying is, if you buy a call option and you buy a bond that will mature exactly at the strike price, that will give you the exact same thing as buying the put plus buying the strike. We can kind of ignore this. Essentially what it's saying is the call is the same thing as buying the stock plus a put. Does that refresh anyone's memory? What do we call it when you buy the stock and a put? Anybody remember what that's called? Protected put. Anyone ever heard that term before? All right, so you can get this two ways. You can get this two ways. One, you can just buy the call option and you put the rest. What do we do? What do we do with the rest? Well, actually, we just did that, right? We bought a bond, right? So we kind of did it. It's not quite put call parity. So we bought a call and we bought a bond. What else could we have done? We could have bought the stock market and bought put options. And we would have ended up with the exact same thing. Oh, we're out of time. So we'll come back to this. I love this theory. All right. So next class, we'll do another example and then we'll talk a bit more about this. All right. If anyone was late, make sure I have you for attendance. No, Marcus, Savannah, I think's on the line. Patrick, Holly, Garrett, SRA, Jade, Cassidy, Alexandra, Joe, Cameron. Cameron, you're here, right? No, he's not. He's on the phone. All right. Mira, Omar, Andrew, Alvaro, Christine. I don't think anyone else is there. All right. Yeah, if you're on the call, well, to get credit, Joe, you have to send me your notes. So I see you on the call, but you have to send me your notes. All right. Thanks, everybody.